But while that inner guts of the system, the web of contracts, is important, the even more important driver of financial instability is simply rising leverage of a particular form, and a particular form on which finance theory and macroeconomics has been entirely silent, or mainly silent, or to the extent that not silent, it has been wrong. If you pick up most undergraduate textbooks, and we were talking earlier this morning about the role of what we have to do in teaching undergraduates and graduate economics, and you see how they describe the role of the banking system, they make two mistakes. First of all, they describe a system which takes money from savers and lends it to borrowers, failing to realize that the banking system creates credit, money, and purchasing power ab initio, de novo, and with an important role, therefore, within the economy. But also, again and again, it says, well, what banks do is they take deposits from households and they lend money to businesses, making, as Joe referred to earlier, the capital allocation process between alternative capital investments. As a description of what modern advanced economy banking systems does, this is completely mythological. This is very well described in a forthcoming paper from Alan Taylor and Maurice Schullerich, reflecting some INET-sponsored research. Basically, in advanced economies, 85% of our bank credit is not to do with funding capital investment. It is funding two things. It is funding either consumption, that may be valuable, but we need to understand why that is, why funding a consumer credit would be valuable and to what extent, and the vast majority of it funds real estate. Sometimes either residential or commercial. Sometimes that is funding new real estate investment, which is a form of investment in the economy, but most of it is funding the purchase of already existing real estate. And it is fundamentally funding in a credit form a competition between ourselves for the ownership of locationally specific urban land. And that, I think, is absolutely fundamental to the instability cycle, because it is that competition for the ownership of existing real estate and of locationally specific land which is in relatively fixed supply that creates instability. Because if you put together the fact that the banking system that can create infinite quantities of credit and money and purchasing power, and that urban land which is locationally desirable is in fixed supply, whenever in economics you put together something which is infinite and something which is fixed, you get an inherently undeterminate price. We have at the core of our financial system something which is bound to create inequality, bound to create credit and asset price cycles and booms, bound then to create crisis and debt overhang and the balance sheet recessions about which Richard Koo has talked so importantly. That really poses a fundamental challenge, because it means that we have a free market system which, left to itself, will create a problem not just of a deadweight cost of too much activity in intra-financial activity that we don't need, but will also create too much of the wrong sort of debt. But with the irony that each one of that debt, seen as its own, looks perfectly socially useful. How could you deny that somebody borrowing for a mortgage is socially useful, but the collective impact of it is something which is incredibly difficult for us to manage and a fundamental problem at the interface between finance and macroeconomics? But to pick up your general point, Paul, I mean, you're quite right. I have posed this question of why is growth so credit intensive, and why does it appear to need to be so credit intensive? And to set out a sort of stylized fact, for the last 20, 30 years, rich developed economies have grown with nominal GDP growth rates of about 5%, but they've had nominal credit growth of about 10 or 15%, which necessarily means that the leverage ratio relentlessly rises, and I think eventually produces a point of a Minsky moment, a crisis, and a post-crisis overhang. And that does pose a fundamental question for us, which is, did we need that credit growth to achieve that nominal GDP growth, i.e. a rate of growth of inflation of about 2–2.5%, and real growth? If it is, if we really needed that credit growth to have the nominal GDP growth, then, as Minsky once said, we do not have an equilibrium in a monetary economy with capitalist financial institutions as against in a Arrow de Breu, Valrasian, seed and corn barter economy. I believe that there are things that we can do to have a less credit-intensive model of growth, but they require things that go way beyond the remit of central banks and financial regulators. They have to do with both the role of real estate within our economy, but also, crucially, the role of inequality, because I think one of the things that is driving the increase in the credit intensity of growth is an inequality effect. If I can then link that to Ed's point, there was something Ed said which I completely and utterly agreed with, and totally agreed with, and I think he put it beautifully, which is, in this area of, if we believe that we can have credit cycles which are out of control and we want to constrain them, we cannot possibly ask the guys who are selling mortgages to take responsibility for it. As you put it, you can't expect them to go into a huddle and say, oh my God, you know, Mrs. X wants this mortgage, seems to be right for her individually, but wow, you know, there's this sort of, you know, fallacy of composition going on here, I've got to think this through. You've got to have that at the level of public policy, and we have got to constrain the credit cycle in public policy. You cannot do that, and that picks up what Axel says, through the inflation target. The inflation target, unlike what Wicksell sought that provided we hit low inflation by having the nominal interest rate in line with the natural rate of interest, all would be well. I think what we've learned is inflation targeting is not sufficient. We need to pay attention to quantity aggregates, but we need to pay attention to them for a quite different reason from what we thought back in the 1970s and 80s. There was a time when we thought that we've got to pay attention to quantity aggregates on the liability side of the bank balance sheet, which is money, because it was a powerful forward indicator of inflation. In fact, we pretty soon realized that money is not a good forward indicator of inflation, but instead the credit aggregate, I mean, it's just the other side of the balance sheet, is a good forward indicator of future crisis and post-crisis recession. But what this does mean is I think we do have to, alongside addressing some of the fundamental drivers of the credit intensity of growth like inequality, we have to have an approach to central banking and macro-prudential regulation which is paying attention to the overall leverage and rate of growth of leverage and where it resides in the economy, and, as Joe said, by constraining it by some policies which some of the developing world have been using, like loan-to-value ratio on limits, which pretty much for the last 30 years, people from the IMF and the World Bank have been turning up and saying, no, you don't want these. These are terribly old-fashioned. They get in the way of the free market allocation of capital. Now, one of the good things that's happened in Canada is that it's actually one of the few advanced economies which also had loan-to-value limits through the conditions for the insurability of mortgages, and you do use those tools. So I think we do have to accept that there is something called the credit cycle, which we have to manage, and we have to focus not on just the objective inflation, nor on just the instrument of the interest rate. Both in terms of objectives and tools, we need a far wider focus.